Today I want to break down how unemployment rates directly influence interest rates, and more importantly, how both affect our businesses, our clients, and our local economy here in Kentucky. The unemployment rate measures how many people in the labor force are actively looking for work but can't find it. It's a key signal of economic health, and it directly affects consumer spending, hiring, and business confidence. From 1990 to 2008, unemployment bounced up and down from a high of 7.5% and a low in 2000 of 4%. In 2009, it dropped from 9.3% with a peak of 9.6% in 2010 to around 4.5% this year. After the pandemic spike in 2020, the labor market rebounded. Today we're seeing a relatively stable rate, which means businesses are hiring and people are spending, according to the U.S. Bureau of Labor Statistics. In 2020, job openings hit nearly 21 million, a record high. When job openings outpace the number of unemployed people, it signals a tight labor market that can lead to wage increases, competition for talent, and inflationary pressure. Why the Fed cares. The CPI stands for Consumer Price Index, a key measure of inflation that tracks changes in the prices consumers pay for everyday goods and services. The Federal Reserve watches unemployment closely. If unemployment is low and inflation rises, they raise interest rates to cool things down. If unemployment spikes, they lower rates to stimulate borrowing and investment. It's a balancing act. In 2025, mortgage rates are projected at 6.70%, slightly down from last year. Inflation is projected at 2.9%, close to the Fed's 2% target. This tells us that the Fed is cautiously optimistic and that borrowing costs may stabilize, according to Freddie Mac. In 2025, the median home price is projected to reach 418,000, which means 21% above the long-term trend of 4% annual growth, according to the National Association of Realtors. This surge reflects years of low interest rates, tight inventory, and high demand, especially post-pandemic. In 2025, mortgage rates are projected at 6.70%, slightly down from last year. Inflation is projected at 2.9%, close to the Fed's 2% target. This tells us that the Fed is cautiously optimistic and that borrowing costs may stabilize, according to Freddie Mac. Average annual mortgage rates started at a baseline of 7.72% in 1972 and rose to 16.63% in 1981. I paid over 18% when purchasing my first home. It then trended downward below baseline in 1993. In 2002 to 2005, it dipped below a new baseline of 6%. After the recession in 2008, interest rates fell to the lowest rates we have ever experienced until the end of 2022 into the last quarter of 2023 and peaked at 7.2% in October. In January 2025, interest rates were 7%, but dropped to 6.26% by September and 6.17% in October. These are not reflected in these slides. These monthly declines reflect the Fed's rate cuts and easing inflation. For borrowers, this means lower monthly payments and renewed refinancing activity. Affordability is a growing concern. In 2024, the average principal and interest payment took up 33% of household income, compared to just 17% in 2012. That's nearly double in a decade. Rising mortgage rates and home prices are squeezing buyers, especially first-time home buyers. Fayette County home prices rose from 180,000 in 2015 to 340,000 in 2025. U.S. national median prices climbed from 220,000 to 418,000 in the same period. The affordability gap widened, especially after 2020, as national prices accelerated faster. Fayette County remains 15 to 20% more affordable than the national average, a strong selling point for local real estate and business investment. Fayette County remains a relatively affordable market, especially compared to national hotspots like the West Coast or Northeast. Price growth is steady but not overheated, suggesting a balanced market with room for appreciation. Homes sell quickly, with median days to pending as low as 18 days, indicating strong local demand. Affordability is better, but mortgage rates and price increases are starting to pressure buyers even in Kentucky. This affects real estate in that buyers may need creative financing or down payment assistance. It also affects lending. Mortgage products must adapt to affordability pressures and services where homeowners may delay renovations or opt for smaller projects. In the retail or local spending, the high housing costs can reduce discretionary income. The final takeaway is that unemployment, interest rates, home prices, and affordability are all connected. Together, they shape consumer behavior, business investment, and local growth.